Welcome to our session on the National Pension System, NPS. This system secures financial security through a regulated framework, designed for retirement planning. The National Pension System was introduced in the 2003-04 budget and became mandatory for central government employees, excluding armed forces, from 1 January 2004. Government contribution was increased to 14% with effect from 1 April 2019. NPS works on two-tier account system. NPS is open to a wide range of beneficiaries, including central and state government employees, corporate employees, and citizens of India, as well as the economically weaker sections through NPS Lite. The structure of NPS is unbundled, involving multiple stakeholders such as the PFRDA, NPS Trust, custodians, pension fund managers, and record-keeping agencies to ensure proper fund management and operations. The Personal Retirement Account, PRA, forms the backbone of NPS, where savings accumulate, which will later be used to provide pensions after retirement. The Pension Fund Regulatory and Development Authority, PFRDA, acts as the primary regulator, ensuring that all entities within the NPS framework operate according to set standards. The Central Record-Keeping Agency, CRA, managed by entities like NSDL, maintains all the information, including unique permanent retirement account numbers, PRAN, and handles all subscriber transactions. In the NPS architecture, points of presence, POP, serve as the subscriber's first point of contact, facilitating registration, contributions, and other transactions, while trustee banks handle the fund flow process. We shall now discuss NPS intermediaries in detail. Pension Fund Regulatory and Development Authority, PFRDA, has been established by the Government of India, Ministry of Finance to promote old age income security through NPS. Regulate and monitor the performances of the entities like PFMs, CRA, NPS Trust, Trustee Bank, etc. PFRDA has established the NPS Trust under Indian Trust Act, 1882 and appointed NPS Board of Trustees in whom the administration of the National Pension System vests under Indian law. Trust indulges in activities like issue instructions to the custodian, pension fund managers and trustee bank. Issuing investment guidelines. To issue directions to PFs for protecting the interest of subscribers. Ensuring compliance through audit by independent auditors. Performance review of pension fund managers. NPS offers full portability, allowing subscribers to switch between jobs and sectors while maintaining the same account. Online access provides subscribers with tools to view their contributions and manage their portfolios. The Central Record-Keeping Agency, CRA, managed by entities like NSDL, maintains all the information, including unique permanent retirement account numbers, PRAN, and handles all subscriber transactions. POPs provide services like provides NPS services to subscriber. Subscriber registration. Regular subscribers' contribution. Change in subscriber details. Change of investment scheme fund manager. Processing of withdrawal request. Processing of request for subscriber shifting. Issuance of printed account statement. Any other service prescribed by PFRDA. Trustee Bank undertakes following functions: collection of funds from identified POP/POP-SP. Pooling of funds at trust account at nodal branch. Fund receipt confirmation to CRA. Remittance of funds to PFMs as per CRA. Fund reconciliation with CRA. Pension fund managers performs the investment management functions under the NPS. PFMs invests strictly in accordance with guidelines issued by the PFRDA NPS Trust. NPS offers fund management by licensed pension fund managers such as SBI Pension Fund, LIC Pension Fund, and ICICI Prudential Pension Fund. These managers ensure that your retirement contributions are safely invested across multiple asset classes, adhering to strict regulatory guidelines issued by PFRDA. Conditions for any entity to become pension fund manager. Sponsors of the pension fund are either a central or state government company, central public financial institution, scheduled commercial bank, insurance company or asset management company, AMC, regulated by RBI, SBI or IRDA. The pension funds are incorporated as a separate company under Company Act 1956, with direct or indirect FDI not exceeding 26% of the paid-up share capital. Sponsors of the pension fund have minimum 5 years experience of fund management. Monthly average AUM of not less than 8,000 crores rupees. Minimum positive net worth of 10 crores rupees. Custodian are required to provide services like settlement processing of assets, safekeeping of securities, electronic, physical custody of securities, corporate actions. Annuity service providers are responsible for delivering a regular monthly pension against the accumulated NPS corpus to the subscriber. PRAN is a 12-digit unique number issued by Government of India, hence can be used as identity proof. In case lost, stolen, provision of reprint of PRAN card on chargeable basis. NPS account can be operated from anywhere in the country irrespective of employment and geography. Subscribers can shift from one sector to another. For example, a subscriber of unorganized sector can move to central government, state government, etc. with same account. Subscriber can also shift within sector also, like from one POP to another POP, within same POP, from one POP SP to another POP SP. To encourage investment in the NPS, tax benefits are available under the Income Tax Act. Contributions made to Tier I accounts qualify for tax deductions under Section 80C up to a limit of 1.5 lakh rupees, and an additional deduction of 50,000 rupees is available under Section 80CCD 1B, providing significant tax advantages. There is no exemption on investments made under Tier 2 account. Let us go through the investment options under NPS. NPS has two-tier architecture. Tier I account enjoys all tax benefits, whereas withdrawals are permitted only under certain conditions and limits. Tier -2 on the other hand provides voluntary savings facility. Subscriber is free to withdraw his savings at will. Tier I account, subscriber will make first contribution at the time of applying for registration with POP SP. The subscriber has option to contribute anytime during the year as per his convenience. Minimum contribution at the time of account opening 500 rupees. Minimum amount per contribution 500 rupees. Minimum amount balance at the end of financial year 6,000 rupees. Minimum number of contributions 1 per year. Tier 2 account, no account opening and account maintenance charges by CRA. Only transactions are charged by CRA and POPs. No limit on withdrawals from Tier 2 account. Investment patterns same as Tier I. No levy of exit load. Separate nomination facility available. Option to select different investment pattern from Tier I. Transfer fund to pension account, Tier I, anytime. Under NPS, choices exist in respect of pension fund managers, approach and investment class. NPS allows subscribers to invest in equities under Asset Class E, with a cap of 50% on equity investments to manage risk effectively. The asset class will be further invested in index funds of a particular index such as BSE and NSE. Investment in unlisted equity shares or equity-related instruments is not allowed. Investment in IPOs is not allowed. The investment in any equity stock is limited a maximum of 10% of the issued capital of a company. No investment in any unlisted security of an associate or group company is allowed. The government securities G fund is a low-risk option, focusing on investments in government bonds and other safe instruments. It provides stability and security, making it suitable for risk-averse investors or those closer to retirement. Although returns are relatively lower, the safety of principal is higher. The corporate bonds C fund is designed for moderate risk investors. Contributions to this fund are invested in bonds issued by reputed companies. Corporate bonds typically offer higher returns than government securities but with slightly more risk, making this a balanced option for many subscribers. Subscribers can choose between two investment approaches in NPS, active choice and auto choice. In active choice, subscribers decide how much of their contributions should be allocated to different asset classes like equity, corporate debt, and government securities. Auto choice automatically allocates funds based on the subscriber's age, reducing equity exposure as they grow older. Subscribers who do not have the financial and investment knowledge unwilling to exercise any choice of investment, then their contribution can be invested in accordance with the auto choice option. In this option, the investments will be made in a life cycle fund. The fraction of funds invested across three asset classes E, C and G will be determined by a predefined portfolio. From age 36 onwards, the weight in E and C asset class will decrease annually and the weight in G class will increase annually till it reaches 10% in E, 10% in C and 80% in G class at age 55. When there is variation in subscriber corpus allocation due to the NAV fluctuation, rebalancing needs to be done. In case of active choice, a cap of 50% on investment under equity scheme is applicable. In case this limit is exceeded, rebalancing will need to be carried out once in a year on the date of the birth of subscriber. In case of auto choice, dynamic, system-driven, rebalancing across scheme as per the age-wise allocation ratio will be carried out on the date of birth of the subscriber. Now we shall discuss contribution payment in NPS. Contributions are payable on emoluments which includes basic pay, dearness allowance and non-practicing allowance along with leave salary and arrears. No contribution is payable on extraordinary leave and suspension if not opted for. Interest is payable on delayed contribution to NPS. NPS contribution to be deposited on last working day of the month. If not deposited, member is entitled to interest on contribution prevailing rate of PPF. Additional interest due to delay to be deposited within 30 days. Applicable on both employee and government share, if delayed. Now we shall discuss option available under Rule 10 of Old Pension Scheme. Benefit of Old Pension Scheme available in case of death, invalidation, disability of a subscriber during service. New joinees to exercise option on joining government service. Existing subscribers to exercise option as early as possible. In case of no option, default option will be considered. Death, invalidation, disability before completion of service of 15 years or within 3 years of notification. Default option would be old pension under CCS, Pension, Rules, 1972 CCS, Extraordinary Pension, Rules, 1939. In all other cases of non-exercise of option, NPS withdrawal would be granted. Option can be exercised any number of times before retirement. Last option exercised would be considered. If invalidated, disabled during service and in position to exercise option, chance to exercise fresh option would be available to subscriber. In case pension under CCS, Pension, Rules is allowed, government will take back its own share of contribution and interest earned thereupon from NPS account of the subscriber. Now let us understand the fund security under NPS. Compliance with disclosure requirements and the code of conduct specified by PFRDA from time to time. Management of pension funds in line with the investment management agreement signed with the NPS Trust. Pension fund maintains their separate accounts and audits are conducted by agency appointed by PFRDA. The audit agency checks the NAV calculation procedure and computation of other charges on subscriber. Periodic reporting and performance review by PFRDA NPS Trust. Long as they live. In some cases, the option to include a spouse or other family members in a joint life annuity ensures that they, too, are financially supported in the event of the subscriber's passing. Risk mitigation is ingrained in NPS design. Option to remain invested even after retirement. Unlike other pension plans, NPS gives subscriber an option to remain invested in the scheme even after the age of retirement. 50% cap on equity with rebalancing feature. To protect the subscriber's contribution, investment in equity is limited to 50%. Auto choice option. Where the subscriber doesn't have financial knowledge, the contribution will be made in predefined portfolio. Option to switch PFM and change asset allocation ratio. Subscriber has option to change PFM if he is not satisfied with the performance of fund, charge structure, quality of service, etc. Subscriber has option to revise the asset allocation ratio based on age and financial goals. Annuity is the fixed monthly, periodic, income which a subscriber will get against the corpus invested. The larger the corpus size, bigger the annuity. Subscribers who reach the age of 60 and opt for superannuation can choose to withdraw a portion of their accumulated corpus as a lump sum and use the remaining to purchase an annuity. At least 40% of the corpus must be annuitized to ensure a steady retirement income, while the rest can be withdrawn to meet immediate financial needs. The annuity service providers, ASPs, under NPS offer various annuity plans that guarantee a steady income after retirement. You have the flexibility to select the type of annuity that best suits your needs, whether it's a life annuity, joint life annuity, or an annuity with return of purchase price. Subscribers must carefully evaluate different annuity options to choose the one that best fits their retirement goals. The decision depends on factors like life expectancy, family structure, and financial needs during and after retirement. NPS offers flexibility to choose an annuity plan that suits individual needs. In normal superannuation, at least 40% purchase of an annuity for PROV for monthly pension to the subscriber. Balance, lump sum paid. In case total corpus up to 5 lakhs, whole amount can be withdrawn. In case of death of subscriber, at least 80% will go towards purchase of an annuity for PROV for monthly pension to the spouse. Balance lump sum to nominee legal heir. In case total corpus up to 5 lakhs, whole amount can be withdrawn. If family opts for family pension, as per regulations, all the accumulated pension wealth shall be transferred to the bank account of the nodal office for further settlement as per government directives. In case of premature withdrawal, at least 80% of the accumulated pension wealth has to be utilized and balance lump sum will be paid. In case total corpus up to 2.5 lakhs, whole amount can be withdrawn discharged from service. Under NPS, subscribers can make partial withdrawals after 3 years for specific purposes such as higher education, marriage, or medical emergencies. A maximum of 3 withdrawals is permitted during the lifetime of the subscriber, ensuring flexibility while keeping the focus on retirement savings. A male subscriber can nominate legally wedded wife, children, whether married or unmarried, dependent parents and Deceased son's widow and children. A female subscriber can nominate. Legally wedded husband. Children, whether married or unmarried. Dependent parents. Husband's dependent parents and deceased son's widow and children. Distribution in the fund amongst nominees' own discretion. Bears family at the time of making a nomination. Any nomination made in favor of a person not belonging to family shall be invalid. A fresh nomination to be made on marriage and any nomination made before deemed to be invalid. If at the time of making a nomination, no family, the nomination may be in favor of any person or persons. Where the nomination is wholly or partly in favor of a minor, appoint a major person of his family to be the guardian. Where there is no major person in the family, the subscriber may, at his discretion, appoint any other person to be a guardian of the minor nominee. Subscriber Education and Protection Fund, source of funding. Grants and donation by central government, state government, companies or any other institution. Interest or other incomes received out of the investment made from the Subscriber Education and Protection Fund. Sums realized by way of penalties under Section 28 of PFRDA, Act 2013. Thank you for watching. For more such interesting sessions, visit www.careerprondia.co.in.